Hello, everybody. Luke Gromen, FFTT. Hope you're well. Hope you had a great weekend. It was a beautiful sunny Sunday here, a little on the cool side, but we are able to watch some baseball, and so that was always a good day. So, at any rate, I'm going to jump right into it. Thank you, everybody, as always, for submitting the questions. A lot of really good questions. So, I'm going to start off with HH. Larry Summers recently mentioned that recession can be delayed with luck and policies such as strategic oil reserve releases, increasing immigration, maybe a few other things. Do you agree? What else can our policymakers do to delay the inevitable? Uh, in my opinion, no. I think Summers is engaging in some wishful thinking colored by his views on foreign policy. U.S. energy spending as a percent of GDP was already high enough to trigger a recession before Russia invaded Ukraine, and the EU's was certainly high enough, and with so much leverage in the system in the West, but broadly speaking, that if the EU has a recession, the U.S. is likely going to have a recession shortly thereafter, or vice versa if the U.S. doesn't have one on its own merits. So, what else could the U.S. do? In theory, it could unsanction Russia, and it could restart QE. Both of those things would work really well. I don't know that we're there yet on either one. It could come up with some sort of new energy miracle cure, if you will, that drops energy prices dramatically immediately and is able to be commercialized. That would work too. I don't think that's on the horizon in the investable future. So I think we're heading for an energy-driven recession. Now, from SJ, at some point it will be wise to buy bonds again. At what point? I think it depends on your time horizon. Are you a trader or are you an investor, real basis? You're looking at bonds on a real basis. As a trader, bonds, sure. Could bonds be worth a punt here or a trade here, given the weakness and growing weakness in the economy, as well as global economic and geopolitical problems? Possible. Possible. As an investor, I don't think bonds are a buy until U.S. debt to GDP has fallen from 125% to 80% of GDP or less. Because until debt to GDP is that low again, the United States cannot afford to pay positive real rates, which means that bonds have to lose money on a real basis until U.S. debt to GDP is that low. And if they're losing money on a real basis, why do you want to be involved as an investor? So that's the real basis side of it as well. And so to me, it really just depends on your time horizon. But as an investor, which is how I look at my own funds, gold is just a bond of infinite duration, finite issuance, and infinite face value. Why would I hold bonds instead of gold when gold is a bond of finite duration, infinite issuance, and finite face value? It just, until the sovereign balance sheets are fixed, broadly speaking, and I pick on the U.S. because the U.S. is the global reserve currency issuer. So we haven't had a situation where the global reserve currency issuer has a balance of payments and fiscal and debt problem in a long, long time. Bonds are not, they can't be allowed to have positive real rates by the issuing authority if they want to work that debt down. So hope that helps. From John, what's your reply to Jeff and Emil's latest video, Jeff Snyder and Emil Kalinowski, both friends of mine, latest video titled, "There is no such thing as a petrodollar. Do they make the Eurodollar system out to be more important than it actually is?" I thought it was a very well done write-up. For me, the issues that I saw with it were that it ignored geopolitics, it ignored the U.S. balance of payments, and it ignored physical world reality, physics. In other words, as an example, how many wars have been fought by the U.S. Since the Eurodollar system really got big, as Jeff and Emil's piece pointed out in the 70s? How many wars has the U.S. fought with oil nations versus how many financial capitals has the U.S. military occupied since the 1970s? When have we invaded Hong Kong? When have we invaded Singapore? When have we invaded London? When have we invaded New York? And the answer is we haven't. When have we invaded the Middle East? When have we attacked the Middle East? When have we been at odds with Russia? A lot. And so the it also ignores the reality that global balance of payments imbalances tend to be very heavily influenced, if not driven, by energy. And so if you have energy driving outsized impacts on global balance of payments, you have energy driving outsized impacts on FX pairs, which means by definition, you have outsized impacts of energy on the dollar, on the Eurodollar system. And that's ignoring, their point in the 70s, they bring it up, how many oil dollars were flowing into London as part of the Eurodollar system. So that's another side of it, is just that balance of payments point. And then finally, I think it also ignores the physics, the real world where the financial world meets the physical world. That, look, all that Eurodollar debt, it cannot be repaid without the expenditure of energy, and energy is primarily oil and gas. So basically, take away oil and gas, all those Eurodollars all that Eurodollar debt is going to default. And that then completely changes the system. That completely renders those assets, those Eurodollar loan assets, impaired, if not worthless. And so I think that is some of the same mistake that a lot of Western strategists have made by looking at Russia's GDP, by mentioning it, by measuring it on purchasing power parity, or by looking at it strictly on GDP, rather as looking at it at value. And value of Russia's GDP is very, very different than Russia's price of GDP. What I mean by that is Russia's GDP, to oversimplify, is the number of barrels they produce times the price per barrel of oil times the number of days in a year. The value of Russia's GDP is the number of barrels that Russia produces times 365 days in the year times the work in each of those barrels. There's 25,000 man hours of work in a barrel times $20 per man hour. Every barrel of oil is worth $500,000 of economic value. Multiply that times Russia's oil output times 365 days, you get a very different result for Russia's economic impact. And that's the one we need to think about when you start talking about removing Russia's oil impact from the global economy, when you start talking about sanctioning all Russia's oil out of the global economy. In a highly levered economy, that is more than enough to collapse the global economy. So those are my, when I thought it was a great piece by Jeff and by Emo, but I think it ignores the second derivative, a number of second derivative impacts: geopolitics, balance of payments impacts of energy, and therefore FX cross pairs, and then the physical world realities of look, there's a lot of debt in the world that's not payable if you take out just Russian oil and gas, let alone all oil and gas. From C, do you see the ruble continue to improve against the dollar? Yes, with an asterisk, with the asterisk being as long as it's in Russia's interest to do so. I think the key is that Russia has conclusively, empirically demonstrated the ability to manage it via ruble for gas and gold, and use it to effectively break U.S. sanctions, which has happened. And this is, we've been writing about it in Tree Ring, saying, look, Russia has far more leverage than Western consensus says. We've been saying this since day one. We were surprised by the invasion, but once it happened, we said, look, Russia has way more leverage than people think. We've seen that play out over the last 2 weeks in real time. And so I think that continues to be the case. So from Tony, how does Russia dropping their fixed exchange rate for gold versus ruble adjust your thesis? Do you still see gold soaring in price as much? It's unclear to me that Russia did that. The Russian central bank press release, when you translate it to English, merely says they're going to a negotiated price from 5,000 rubles per gram. It's unclear to me if that means a drop, or if it means a rise, or if it means a move depending on Russia's needs. The Reuters article seemed to imply a drop in price. I'm not sure that that's the case. Either way, I think it's important to take a step back. As one of my best relationships on Wall Street pointed out to me, we were talking about it last week. He goes, Luke, look, is it up and down? Is it up a little? Is it down a little? I don't know. But don't miss the forest for the trees. A major global central bank, the central bank of the world's biggest energy exporter, has drawn a line under gold. They are bidding for gold. That's an enormous signpost in and of itself. And I think that's the right way to think about it. It's how I'm currently thinking about it. From Rob, question: how could gold become a reserve asset given the difficulty in proving authenticity. There's many tungsten bars, which are difficult to verify versus smaller coins unless you melt them down. Also, the difficulty in transporting gold. The U.S. used to send a plane full of gold bullion to Saudi Arabia at least once a month. I believe as recently as the mid to late 60s. And in terms of the difficulty, I think look, no gold, no energy. You don't send the gold, then you don't get next month's shipment of energy. I think it's a very powerful motivator. Is that difficult? Is that expensive? Does that take a lot of effort? Absolutely, it does. But so does finding and producing oil. And this is where I think the world needs to move to, where the world wants to move to, where it has to move to if we don't want the system to collapse. Is we need to move to tough to produce oil and gas for tough to produce gold, because what we're watching is the producers in the world, not just of oil and gas, but of goods, saying that the tough to produce oil and goods for easy to produce negative real yielding treasury bonds is going to result in our bankruptcy. And so, yes, is gold hard to assay, move, transport, ship, all that? Absolutely. But so's oil, so's gas, so are factory goods. And so this system that we've all grown up under, that, hey, the world is going to give us very difficult and expensive to produce goods for treasury bonds that can be created by a keystroke, that's the world that's ending. And so I think, yes, gold is absolutely a pain in the butt to move. So is oil. So I think that's really where we're moving. From NP, when is the last time the world's financial system was balanced against or for commodities? What are some lessons we can learn, or how do we prepare for a world where commodities reign supreme? I don't know exactly how to sort of think about that. I think I would look at it as take a look at gold as a percentage of financial assets, total financial assets outstanding, as a read on when that last happened. And I want to say you go back to like 1980, I want to say gold was still 2.5% or more of global financial assets. And that would probably be the tail end of the last time that this was the case. And so the outcome would be that for gold to really be able to settle commodities, for gold to serve as a neutral reserve asset to settle commodities, you're going to have to reprice gold orders of magnitude higher with a much smaller paper market, or at least a paper market with much less influence on the physical market. With that said, I'm not sure that commodities will end up reigning supreme per se, but I do think that what we are in the still the early days of is share of global economic value accruing to commodities and commodities producers is likely going to rise meaningfully here secularly. It needs to, in order to get the capital to get the commodities produced that support the rest of global economic activity. And that economic activity share accruing to commodities producers is at near historic lows. And so I think it has a ways to go. From Edwin, do you have a thought as to the general time frame when you think the Fed might be forced to announce that it's changing directions? I think we're probably 3 to 4 months out, in my opinion, at the longest. Rates around the world, particularly in the West, are becoming problematic. You've already got the Japanese and the Chinese getting more stimulative, which are generally a leading indicator for what the U.S. does. Global geopolitics and trade are also serving as effective rate increases to liquidity withdrawals, becoming problematic. So I think we're probably 3 to 4 months out from the Fed having to reverse, probably at the longest. From RH, hi Luke, in a crisis, do you think the Canadian government could try to solve its no official gold problem by nationalizing the mines? How would shareholders fare in such a scenario? In a word, yes, I do, especially in the aftermath of Prime Minister Trudeau's actions, shall we call them, in regards the trucker protest a couple months ago with what he did with financial and bank accounts. I think ultimately this continues to move towards this if you don't hold it, you don't own it dynamic that is one of the defining features of macro and financial markets here year to date with the FX reserve sanctions the US and EU put on Russia. Question for me is how it would be structured. Would Canada nationalize its mines? I think it's entirely possible in extremis. B, what would that look like? In my opinion, it would probably be, were it to happen. And again, this is a tail risk for me. This is not my base case. I want to make that clear. But if it were to happen, I think it would be something along the lines of all excess profits over $2,500 per ounce or $3,000 per ounce would accrue to the Canadian government or something like that. And so basically, Canadian government would be buying all physical from their own mines at $2,500 or $3,000 an ounce effectively. And that's still a really good outlook for miners. It would probably lead to massive dividend increases amongst miners as they pay out the resulting profits to shareholders. However, I think it's entirely possible, if not likely, and I do think this is likely, that physical gold outperforms the miners in the in this cycle, which is unlike the 70s gold cycle and the 30s gold cycle. I think it's very possible, if not likely, that physical gold outperforms the miners as a result. From Brian, for those of us who have been contributing to a 401k for 20 to 25 years, what's our move with an impending unwind coming? Already moved to a nice portion of a number of different Bitcoin miners, Bitcoin holdings, etc. Do we sell, take the penalty, and just buy Bitcoin outright to protect ourselves? I would not sell everything and pay the penalty on 401ks. The outlook is not great right now. And there's a lot of very potentially dramatic things that could happen. For me, I think you want to diversify. And there's a number of different diversifications. I think you want to own politically acceptable inflation hedges and non-politically acceptable inflation hedges, right? So the former, politically acceptable, it's stocks, real estate, commodities. Non-acceptable, gold, Bitcoin. I think you want to diversify amongst your allocations broadly. So I continue to think, given the where we are in the long cycle with debt, given the extremes of what's happening with entitlements, geopolitical developments, how political markets are, I think you need what we've referred to before as the Jacob Fugger allocation, which he was the richest man in the world historically as a percent of the economy. And he had a very simplistic approach. It's 25% cash, 25% stocks, 25% real estate, 25% gold, and then reweight as needed. Now, for today's time, that's my version of today's time. I would mix depending on your risk ability. Maybe it's 20% gold, 5% Bitcoin. Maybe if you're really strong on Bitcoin, maybe it's 20% Bitcoin, 5% gold. I don't know. A quarter of it though, you want to have in a neutral reserve asset. For me, it's mostly gold with still a lot of Bitcoin. His originally was bonds, cash, real estate, gold. For me, as I mentioned before, gold and bonds are very similar instruments. Gold has infinite duration, finite issuance, and infinite face value. Bonds, with especially with negative real rates that they need to be to finance governments, are finite duration, infinite issuance, and finite face value. So I just think I'd rather own gold than bonds until government's fiscal positions and sovereign debt positions are in a position where they can raise rates without blowing up the system, where they can actually afford to pay positive real rates. And so I think that's how I would think about it in terms of just this diversification of politically acceptable, non-politically acceptable, diversification across asset classes. And then too, I think this ties into the politically acceptable versus non-politically acceptable, acceptable versus non-politically acceptable. I think you want to own assets in the system and assets out of the system, right? So your gold and your Bitcoin are out of the system. I don't think you want to be entirely out of the system though, because look, the system might win and the system might sustain. And so if you start paying huge penalties on 401ks, things like that, they're very tough to overcome. So I think you want to have your 401ks, your IRAs like that. I just don't think it's prudent to be pulling everything out and putting it all into a Bitcoin or a gold or cash. There are so many things that could happen where it's such stretched extremes on any number of metrics that I just think you need to be diversified across politically acceptable, non-politically acceptable asset classes and system versus not system. Let's see. And last question from RD. Hey, Luke, what are the chances that spiking bond yields cause the Fed to enact yield curve control? and that sends risk assets higher without any downturn occurring first. Base case seems to be recession/decline, then printing money, but trying to evaluate alternative possibilities. I think it's very possible. There's an increasing number of market participants sitting in senior seats around Wall Street that understand the implications of the U.S. fiscal situation, the U.S. debt situation as a reserve currency issuer. They also understand what's going on in Europe, China. I know this because I interact with a number of them, and they understand more broadly that sovereigns more broadly, that basically the bubble is in sovereign debt this time, and that sovereigns broadly, as a result, are in no position to allow yields to rise too far. And so, given that, in terms of just senior market participants understanding this, a growing number of them, it's entirely possible that markets just look right through any valley of a recession. And I think gold might be an example of this beginning to happen. In other words, the fact that gold is still rising with real yields and nominal yields doing what they have done year to date is a huge correlation break. And one of my best relationships on the street always says, listen, it's these macro correlation breaks where there's really important information. And to see gold doing what it's doing while rates are doing what they're doing and real rates are doing what they're doing, huge macro correlation break that's telling us basically there's a whole bunch of people saying, I don't care about real rates rising as it relates to my gold. Rising real rates are going to bankrupt sovereigns. And the last thing I want to do ahead of real rates breaking sovereigns is sell gold. I want to buy gold. And that's what I think we're seeing with gold. As rates rise, gold's rising. And I think that's why. As rates rise, sovereign debt crisis for even the United States gets closer and closer. And that sovereign debt crisis looks like yield curve control. It looks like everybody doing what Japan did. And I think that's really positive for risk assets broadly. So the question then is are risk assets, in addition to gold, going to look across the valley like gold has been looking across the valley? It's not my base case, but it's a very valid question. Now, it's still not my base case, but I think it's very possible that risk assets just completely look across the valley. And importantly, unless you're a trader month to month with a marked month to month, when you look at the fiscal and debt positions at the U.S., Europe, globally, that with the problem at the sovereign debt, where all these countries can print money to keep sovereign debt nominally solvent, any big downturn, I think it's going to be measured in weeks, if not days. And so, like I said, that's why it really comes down to if you're trading week to week, month to month. Hey, I get it. But for our purposes, for my purposes with my own funds, I don't really care month to month because we can see where this is all going. And as long as we manage our chips, so to speak, in a conservative enough manner, right? That Jacob Fugger type allocation where, look, you're sitting on a huge, I've probably got up to 20% cash right now. That's my volatility hedge. And that is also, for me, it's optionality. We got a lot of commodities, gold, Bitcoin, some real estate positions. I'm under levered. And look, if I'm wrong on the political timing, if something happens, I have that dry powder where I can add to it because we can see with the sovereign debt positions where they are, US, Europe, around the world, unless sovereigns are going to be willing to stand aside and allow themselves, their central banks allow these sovereigns to default on their obligations, both debt and entitlements, then we know the central banks are going to have to react very quickly and very aggressively like we saw in 2020. So with that, I'm going to finish up for today. I want to thank everybody again for joining me. As always, if you'd like to check out what we're up to, learn more about different appearances, etc., you can go to FFTT-LLC.com. You can also learn about our Tree Rings product there, which is 10 most interesting things, quick synopsis of each about different events, etc., news stories that either fit or don't fit a lot of times with trying to triangulate into what's happening out there for our clients. So everybody have a great rest of your week, and we will catch up with you soon. Take care, everyone.